So Tony mentioned, what we in the business call a loss limit. And also you hear what I call layered programs out there. So where, carrier A might write the first 10 million, carrier B the next 10 million, carrier C the next 5 million, something like that. And the reason in many cases it is an option and they're still out there, but in some situations, neither carrier A, B, or C can do the whole 25 million by themselves.
Why?
Yeah, because some carriers don't have that capacity to do that. Some carriers specialize only in the primary layer where all the premium is. That's what they want. They want the big premium and they want the loss limit. Some carriers only specialize in the excess limit. So you don't find these types of layered programs in most of what I'll call the garden style variety type product, unless it's a unique situation where they have a claim and they couldn't get insurance and you end up in what is called the surplus lines market, because these layered programs and or loss limit programs are what we call the surplus lines arena. So there's the non-surplus lines, which is your heritage, your American coastal, your first protective, your standard markets, that everything they do has to be approved by the Department of Insurance. And then you've got your non-standard line or surplus lines carriers where they're still under the scrutiny of the Department of Insurance, but they have flexibility to do things like loss limits or layered programs, things of that nature.
Surplus, is that the same thing as saying a not admitted carrier?
Correct, yeah. So again, admitted, standard lines markets, non-admitted, surplus lines markets, non-admitted markets, yeah, same things.
And I don't know if Doug's going to agree with this, but some of my favorite carriers, by the way, were surplus carriers.
Yeah.
Like the ones that paid the best, were the best claims handling, were surplus. So the only reason I'm mentioning this is for newpers that are watching this. I felt like when I first started as a manager, and it was probably just in my head, that we only wanted admitted carriers. That's the best. We want admitted, A-rated, like all of this. And then after I went through a couple of storms.
Well, there used to be a rule, and I'm really dating myself, and I think probably most states have a similar rule, that you could not go to a surplus lines market unless you were declined by the admitted markets.
Really?
Yeah, there used to be a rule years ago. We had to complete what's called a surplus line statement, list the admitted carriers that we approached. They said no, et cetera. So, that changed because, you can just imagine how constricted the market was. You know what I mean? After Hurricane Charlie and Wilma, for example, because some of the admitted markets like State Farm, Nationwide, and Allstate kind of bailed before Hurricane Charlie and Wilma came through. So I don't believe that same law exists right now. You can go direct to a surplus lines market, if I recall. But they both have their place. Neither one is bad. As far as the carriers that we represent, we're permitted by our errors and omissions contract, because we don't write business with an admitted carrier that has at least can have no rating whatsoever by AM Best. But a non-admitted carrier has to have an AM Best rating of a certain category or better. And I think exceptions are made on occasion to work with certain carriers. But yeah, it doesn't have to be admitted, doesn't have to be non-admitted. We get that question on occasion. I've had some declaration of condominiums that are quite dated that I've encouraged them to change, that required AM Best A+ size 15 admitted paper, which doesn't exist.
Yeah,
you know what
you're
I
not
mean?
going to have insurance.
So that's something I hit a point on, is that I do think insurance agents should refer to the Declaration of Condominium to see what requirements exist in there, because there are requirements like that an insurance agent, if they don't do their due diligence and look at the Declaration of Condominium, might put you with a non-rated carrier where your declaration requires AM Best A+ rated or something like that.
We appreciate that. And we're very lucky that most of the agents that we work with, there's a small group of agents that we work with. And you are one of that small group. I don't think anyone at Newell doesn't know who Doug is, but Doug has you're very well known in this. You're one of the predominant people that writes this type of policy. That has been, I'm getting off topic. There's a couple of agencies out there who almost like crap. They're very good at recruiting new people, which we're all about here at Newell. Obviously, we like to recruit and train new managers, but they don't recruit and train new insurance agents. They recruit and train salespeople. And then the salespeople are cold calling directors. And then the next thing we know, we have a director who we're having to kind of re-educate because they've been told we can do X, Y, and Z, and you really can't. We've had situations where entirely wrong policies were signed. And they're trying to find it. So another rule, work with somebody who knows what they're doing.
Yeah. And Tony mentioned loss limit, just to add a little color to that. So a loss limit, I kind of touched on a layered program where you layer carrier A, B, and C to get to the insured value. A loss limit is a situation where you might have a $25 million value based on an appraisal, but you only buy $10 million worth of cover. Now, my recollection, Collier County did that for years. They had a PML, probable maximum loss study done. If they had, $3 billion worth of property to insure, and they had a PML study done that determined maybe $300 million was their maximum loss, but then they bought excess of that just to kind of cover the bases.
Did something like that with the airport when we were doing with that.
Yeah.
Now, circling back, that actually would be a place where this new statute would be helpful.
Yes. The answer is yes. I was going to say the challenge is, and not so much a challenge, is that the admitted markets, which are the major players in your garden style variety, 2-3 story heritage, American coastal, they don't do loss limits. Okay, they're not filed to do that with the Department of Insurance. That's when you get into the arena of your surplus lines markets. What historically surplus lines markets were carriers that you went to when you couldn't get coverage in the.
Is it Empire one of them?
So Empire, which is morphed into Steadfast, both subsidiaries of Zurich, yes, they've always been surplus lines carriers.
Maybe was it Lexington, another one?
Lexington was a surplus lines carrier.
There were two. I'm not advertising anybody because they were two. Those were my two favorite carriers.
Yes. Yeah, and the ability, surplus lines carriers, for example, have the ability to manuscript endorsements to address a specific need. And I've never done this, what I'm going to give you an example of, but I could go to a surplus lines carrier and say, I want the hurricane deductible to be 2% or nothing on the first Tuesday of every month. And they could literally manuscript an endorsement to do something like that. Whereas a non-surplus lines carrier like a Heritage or American Coastal, they can't do that. It has to be approved by the Department of Insurance. So
they're like a game of craps. I'm convinced that insurance is just a big craps table that,
there's more flexibility out there in the surplus lines arena. So there is a need for surplus lines carriers, probably even more so in the state of Florida, where we have, limited number of carriers doing business. And I don't even mention the excess umbrella markets. I've been around here since 2003. I remember when I first came down, a great American insurance company through distinguished programs in New York City, which is a nonprofit community association umbrella program. I could go out and buy a $5 million umbrella for a 50-unit complex for $800 or $900, and then $10 million was $1,000, and $15 million was $1,200, $25 million was $1,500, and so on and so forth. Up to $200 million they made available. I had clients that bought $200 million for $3,500, high rises on the beach. That all changed after that tower collapse on the East Coast in June of 2021. There were probably 10 different programs available prior to that tower collapse. Now there's effectively, from a program, which is kind of a countrywide nonprofit community association excess umbrella program, there's probably two. And the two are Great Point, the Great Point program, which has a criteria that everything has to be within 20 years old. So plumbing, electrical, roof, you name it. And then there's the Greenwich program. And Greenwich has its own guidelines too, as far as number of rentals, age, height, et cetera, et cetera. So we've gone from maybe 10 or 12 markets to 2 markets. And we all know if there's 12 gas stations on a corner, they all compete with each other on price and product, right? But if there's one in a 5-mile radius, they got kind of a captive audience. And that's where we kind of exist right now in the umbrella market, is that there's just so few players, and the pricing has escalated rather dramatically, probably more so with the Greenwich product than the Great Point program product. I think we're starting to see that. I think they realized they went too far, because I've seen some that were $5 million that were going from $1,600 to $2,400 are now coming in at $1,800. So I think the market's starting to moderate a little bit there. Not that any new entrants have come into the marketplace, but I think they just realized they stepped too far ahead. But yeah, it's a challenging line of insurance. Everybody knows probably what an excess and umbrella is. It's higher limits of insurance in case there's a catastrophic event and you blow through what is called your primary limits of insurance. It's excess typically over your general liability, your directors and officers, your employer's liability, your non-owned auto. So again, higher limits.
Pretty much everything but your property, right?
Correct, yes. It's excess over what we call the casualty lines of insurance. And make sure of that too. We talked about the word umbrella. When I cut my teeth in the business circa 1987, there were true umbrellas. And a true umbrella had a drop-down feature. So kind of picture an umbrella, it drops down. A true umbrella had a feature that said everything that's covered by the primary is covered by the umbrella, but there are some things that might be excluded by the primary that are covered by the umbrella. It would drop down and become primary. Well, most of what you see these days is what they call excess liability. It's straight excess. It's excess over your primary coverage, but you still have to watch because the excess carrier might attach exclusions that don't exist in the primary coverage.
There's a lot of holes in the umbrella.
Potentially, yeah. And your agent should be vetting all that kind of stuff out. It's not just going out and getting a quote, it's vetting the terms of the quote.
What I always find interesting is reading those exceptions and realizing that for some of them are pretty crazy, right?
Yeah.
But you realize something created that exception, right?
We're seeing exclusions and policies now for firearms, for animals. You might think, okay, firearm. You might think animal. I had a situation with a client where a man and woman walking their dog, and a raccoon came out of the woods and attacked the dog, and then the man went to save the dog and attacked the man, and the manager thought, well, how are we involved in this? Well, it happened on our premises. You know what I mean? So if they sue us, our policy step in and defend us against the allegation. And I mentioned that because I think defense is one of the key components of an insurance contract. You know what I mean? Getting defense coverage, getting the experts on your behalf, getting in and defending you against the allegation. We are seeing, and again, I keep going back to that June 2021 collapse, but that did cause several liability carriers to kind of exit the market or be very particular about what they'll insure. Auto owners, Southern Owners, who is a big carrier that we use right now, they changed their guidelines to say, I think, no new business over 5 or 6 stories high or nothing over 25 years old. And again, all the result of that tower collapse has had just a profound impact on the insurance market for property, liability, directors and officers, umbrella excess liability in the state of Florida, and probably countrywide. Not just a phenomenon here in Florida. Other than community associations are having challenges getting contractors, for example, getting higher limits of umbrella insurance these days too. Just getting it, let alone the price.
Yeah, so I live in my own little bubble here, which is an interesting bubble because apparently our bubble has raccoon attacks.
Yeah.
And that's got to be fun to handle the defense on. We have a team member here who actually owned a management company in California for about 10 years. And we were talking about some stuff that's in our statute. They have actually, for quite a while, have had similar things in their statute, which surprised me, primarily related to like earthquakes and all of that kind of stuff. Because I should get Clarissa to come in here and we'll talk with her about this. But my walkaway was that, an earthquake could partially damage a structure. Nobody's aware of it. There's stuff with balconies, all of this kind of stuff. So they passed statutes for it. So I think that the Surfside collapse definitely is going to echo across the nation, but I have a feeling that it's probably worse in Florida, the same stuff in California. And then what makes that interesting is, as far as I know, most insurance markets are regulated on the state level. And so now we've got these state statutes that are coming in also responding to the same thing and the same mix. So a raccoon attack.
Yeah, and again, it happened. And, of course, when he called me up, I explained what the possibility could be. So again,
was there a suit or anything?
Yeah, so the man ended up incurring medical expenses, and the general liability policy took care of the medical expenses because they occurred on the premises of the association for the man. Medical expenses are included in most general liability contracts, and I call them kind of good Samaritan stuff, you know what I mean? To kind of avoid the lawsuit being brought forth, maybe for medical expenses occurred in regards to something like that. But yeah, just, price, is an important consideration, but what you get for the price is more important. You don't want to find out you got a cheap product from a price perspective and find out it's a cheap product that doesn't perform for you too, because it's got some kind of an offensive exclusion in there that, you just need to be aware of.
Yeah, insurance is interesting because it is, in many cases, one, if not the largest line item that our associations have. And they do, we want to get a good deal.
Right.
But one of the things that we've learned is, and it's so hard to know what's going to happen from year to year, different carriers, and I know I named some. So those carriers that I named, the adjusters were out immediately, right? Yeah. They had great adjusters who were on site. They took care of everything. Some of them even showed up bringing tarps. They're like, here, we'll help you. And then there were others that just trying to get the adjuster to show up was huge, right. And it took us forever to get them to show up. And then they'd show up and we'd submit everything and they'd come back and we had pictures of the wrong property that the adjuster took. And we're like, where were you?
Right.
What property even is this? So definitely trying to find companies. And the other thing I've learned is that the companies vary from disaster to disaster. The experience we had in Irma was very different than the experience we had in Ian.
Yeah.
And it was very different than the experience we had in Helene.
Yeah.
And it was very, very, very different from the experience we had in Wilma, because that was its own.
Yeah, maybe to speak a little bit to claims. There's an opinion, like we talked about earlier. There's legal opinions. There's an opinion on the insurance company expert side and an opinion on the association expert side, right? And there are both opinions as to what maybe caused or compromised that roof. Is it because it's 25 years old and it's been through 10 storms, or is it because it's this particular event that just occurred recently? Something that I would say is probably more unique from my experience anyway, and everything I say is my experience, my opinion, is that in Florida, we have a lot of insurance companies that, use maybe third-party adjusting firms. They're not W-2 employees. They're third-party adjusting firms. They might have a small staff of W-2 employees on staff to handle the routine day-to-day water damage water damage claim, lightning strike, things of that nature. But when a hurricane occurs, prior to that hurricane, maybe have on retainer independent adjusters that come from all over the world.
Mostly Texas.
Yeah, we see them come from all over the place. Some may not be as versed in Florida statute. Some might communicate information on the ground when all they're there really is to collect factual information instead of conveying yes or no or something, in my opinion anyway. And then, unfortunately, what we see too is, I had claims with insurance companies who had field adjusters that were independent adjusters that turned over 4 times. You know what I mean? So it was one adjuster, then another, then another, then another, and you got to recreate the wheel each and every time. So that can be frustrating. And just like in any business, in property management and insurance and the insurance carrier side, the adjusting side, there are really good people and people that aren't so good, right? It's in every workplace out there. So it can be frustrating. But you mentioned a couple carriers. Lexington was that NSM insurance group that, have adjusters countrywide. Steadfast and Empire had adjusters countrywide that would come in and handle claims. And other carriers do too, you know what I mean? But a lot of them use, but not like State Farm, where you deal with a State Farm adjuster who has the authority to write the check. You know what I mean?
No offense. I do miss State Farm.
Yeah. They started exiting after Andrew in 1992.
That was
started
forever ago.
Yeah, they started after Andrew in 92. There was some kind of a statute that existed in Florida, I think, if I recall reading it. They could only non-renew 5% of their policies every year. They couldn't just leave the market the next day. Yeah, State Farm, Nationwide, and Allstate, when I came down here circa 2003, in fact, when I was interviewing coming down here 2 years prior, if you looked in this periodical called the Business Insurance Journal, talked about all these insurance agencies that were trying to sell, you know what I mean, like Nationwide and Allstate, because they were pulling the plug on supporting property insurance in Florida. Yeah, we need more participants in Florida, more insurance carriers. That's what's going to help consumers, more competition, more capacity, things of that nature is going to help immensely. And we're moving in that direction right now. I'm optimistic for at least the foreseeable future until that next massive hurricane occurs, right? I'm optimistic about the marketplace for the consumer.
The other interesting thing, thinking back about State Farm and all that, is that, they did have to exit because it was a loss. And that's an important thing I think we always have to remember with insurance is you should not be getting more money from your insurance company than you're paying them. Because if you are, then we end up in the situations, which I won't name some names, but we've had some that basically went to pump. And so if their claims exceed, the idea with insurance is you're paying money in, and in an emergency, you end up getting some money back.
Yeah, as the story goes to talk about State Farm, again, I've heard this from a couple different folks. Hurricane Andrew almost put State Farm out of business.
I heard.
My understanding was they lost almost every penny they had earned since like 1920, whenever they were formed or something like that. And subsequent to that, and again, this is what I recall reading or hearing, State Farm created State Farm of Florida LLC. It was no longer State Farm Flemington responsible for everything. They created, entities. Maybe Texas might have something similar. California might have something similar to kind of shield corporate, so it wouldn't take down the entire thing. One thing I see on our note list here, Adoni, we talked about layered master policies, AOP.
Oh, yeah.
And it's interesting. Adoni knows what that is. I know what that is. My staff, when they help me with proposals, they'll put, CYHD, or they'll put AOP. I try to always make sure in the proposal it's in layman's terms. AOP means all other perils deductibles. But it's CYHD, calendar year hurricane deductible. So not everybody's an insurance expert or nerd or something like that, like I am, like Adoni understands all this stuff, but I try to get my staff.
I was typing quickly.
No, I understand.
So
I try to get my staff, they'll put that in the proposal, AOP or CYHD, and I'm like, my client's not going to know that. You got to spell out calendar year hurricane deductible and all their peril deductibles. So, he mentioned here, hire all other peril deductibles paired with loss assessment coverage and carrier-approved risk mitigation projects. So we've seen some upward pressure on the all other peril deductible over the years too. American Coastal used to do 1,000, then it went to 2,500, then it went to 5,000, then in some cases after Ian it went to 10,000, went to 25,000. We've seen it moderate more back to 5,000. Again, just indicative of the market, it's competitive. Historically, my career in the business, those types of deductibles have been used as a tool to make you understand you've got skin in the game. What I mean by that is if you have a $2,500 deductible and you have 4 water heaters that burst over the policy term and the carrier pays out, $7,000-8,000 on each one for common area damage, well, the insurance carrier on the renewal might come out and say, you know what? let's put a $10,000 deductible on that. Do something about the water heaters out there. And going one step further, so I think a lot of insurance companies use the All Other Perils deductible as kind of a tool for risk management purposes, okay? There's not a lot of premium relief when you go from a $5,000 to a $10,000 All Other Perils deductible or $5,000 to $25,000. Depending upon the carrier, you just don't see any kind of, because again, most of the incidences that you have are less than $5,000. Water leaks, $3,000 worth of drywall. You know what I mean?
It's almost always.
So if there's no claims in excess to the deductible, going to a higher deductible typically doesn't warrant or justify any premium relief. So again, certainly consideration for options, that and a higher hurricane deductible. Loss assessment coverage. I don't do personal lines. We've all been through this. I mean, I do have conversations with clients when they look at choosing their hurricane deductible as far as how can that hurricane deductible be met? Using the roof reserve, using, loss assessment coverage from each unit owner and kind of compiling all the numbers and factor that in your decision-making process. Again, I don't do personal lines, but my understanding is that, like when I lived in homeowners association, I think I bought $50,000 worth of loss assessment coverage. And it was not only property, but it was liability too. Okay, now this was up in Ohio, so different than Florida, but I'll explain what I mean by that. So we had a pool community, and if somebody drowned at the pool and the association got sued for $10 million and lost a judgment for $10 million, and we only had $5 million in coverage, then the association could assess all the unit owners to make up the difference for the $5 million we needed. And I carried loss assessment coverage to help me pay that obligation. My understanding when it comes to a hurricane deductible here in Florida on a homeowner's policy is to make available higher limits for loss assessment, but it's typically capped at $2,000 for a deductible assessment from the association. Now,
on the policy.
Yeah, on the homeowner's policy side. Now, some carriers it might be $5,000.
Statute requires $2,000. And so most of them just do what the statute requires. And we're talking about the HO6 policies right now.
Correct.
So this wouldn't impact, he was talking about single-family homes. Single-family homes is a different thing.
My understanding is, even though you might buy $5,000 or $10,000 worth of loss assessment, I think most carriers cap the most they'll pay from a deductible assessment that their client gets, their HO6 client gets from the association. Now, some carriers might go a little higher, $5,000 or $10,000. But again, where I'm going with that is that when I meet with my clients and we start talking about hurricane deductibles, we'll factor in reserves, age of the roof, potential for loss assessment coverage. And last one here, and I think it's fantastic, carrier-approved risk mitigation projects.
That was actually going to lead me into my last thing, which I don't know. But you do yours, and then I'm going to ask you about flood credit.
Okay, yeah, I'll say this. Carriers are not likely to approve your mitigation projects, you know what I mean? Because what they might tell you today, like if you put a new roof on, it's a 10% discount. Well, it's a 10% discount potentially of today's premium. But if the premium goes down from $100,000 to $50,000, well, it's 10% of $50,000. Or if it goes from 100 to 200, it's 10% of now $200,000 potentially. So they are reluctant to put something out there that says, here's the credit. They might say, well, we think it'd be around 5 to 10% if you put a new roof on today, on today's premium. Because somebody might say, well, 5 to 10%, so it's 10% of $100,000 is $10,000. The next year, the premium goes down to 50, and they might still think they're entitled to a 10% of $100,000, $10,000 credit. I made a note here, risk management techniques. So certain things that we did a study several years ago, what I'll call the nuisance claims that associations encounter, the water heater that leaks, the washer hose connection that burst, people that don't have homeowners insurance, don't have an HVAC service agreement. These are all things that can lead to issues. So having a water heater replacement program when it hits 10 years old, having home watch maybe suggested and the rules and regulations are required in the declaration of condominium, homeowners insurance. I say that because some of the worst claims we see is when the unit owner doesn't have homeowners insurance and they kind of drag their feet in making repairs or restoration. Things like that just mitigate. I think you can't eliminate, but they mitigate, kind of like what they call pest control. They don't call it pest elimination, right? They don't eliminate the pest, they control the pest, right? So mitigation efforts, it's not going to prevent, it's going to mitigate the possibility. Those are more from a property perspective, but you wanted to talk about flood insurance, right?
Yeah. So here's something that's probably only started in the past 3 years that I'm aware of is flood barriers.
Yep.
They've actually existed for a very long time. I was probably in high school. My sister, I think, worked at one of the beach hotels. And they were going to deploy this thing called the hydro wall or something, which did not get deployed. It didn't do anything in the place. But thankfully we didn't get flooded. So now we're starting to see whether it's damn easy or actually engineered flood devices, which are being installed, which are great.
Yeah.
To my knowledge, we haven't seen any credit like we do for impact windows or something like that.
Right. Yeah.
Have you seen anything? Have you heard anything?
No, not really. I mean, not that I'm opposed to taking those measures, but FEMA has certain guidelines about flood panels, for example, in a certain flood zone area, be it B, A, AE, whatever the case might be, that you may be entitled to credit. But for the most part, the properties that are contemplating this now, there aren't credits that FEMA makes available. Now, what I encourage people to do is it shouldn't prevent you from maybe taking those measures. Because let's say if you've got a high rise, 18 stories, and they buy $25 million worth of flood coverage, and their premium is $25,000. And I say that's the out-the-door cost. In that $25,000 is their HIPAA fee, their federal policy fee, their reserve fund assessment. So the true premium might be $20,000. If you got a discount of 10 or 15% on that $20,000, if you did by putting up a flood barrier, 10 or 15% of $20,000 is what, $2,000, $3,000. So you don't do it for that reason. You do it keep the floodwaters from getting in, causing aggravation. In many cases, if your building is a post-firm elevated, there's limited coverage below the elevated level.
So, and I probably should have phrased this a little differently. I was thinking more along where I would like to see it is in our excess flood insurance plan. Because most of the time when the wonderful and terrible thing about FEMA flood insurance is if you've had it forever, your cost is just quite low, generally speaking. Even with Flood 2.0 or any of that, everything's on multiple versions, I'm just realizing. Does that mean I'm getting old? Like, we got Flood 2.0, we got Condo 4.0.
Good thing you live long enough, you hear that kind of stuff,
everything's
right?
on multiple versions. Where we end up seeing very expensive flood policies will be, for instance, our co-ops. The cooperatives have difficulty acquiring flood insurance because it's basically $500,000 a building.
Right.
So we're going to go to the excess market, pick up this flood insurance, which is extremely expensive. Because I understand FEMA's going to have difficulty, I would just assume, any federal agency is going to have difficulty maneuvering, trying to turn a whale. Right. But in a surplus lines market, they can do whatever they want. So that's where I was thinking. Have you seen anything?
No, the flood insurance market, we had some private market players like Voyager Indemnity prior to Hurricane Ian. Well, since Hurricane Ian came through, they exited the market. They realized that the federal flood program is the only one that can really handle it. I think they're starting to dip their toe back in, but they're really cherry picking stuff, not flood-prone areas, maybe inland, higher elevations. But you're right. Co-ops, condo associations, just for everybody's refresher course, can buy $250,000 per unit times the number of units. So it'll pay up to $250,000 per unit. So a 10-unit structure, they could buy $2.5 million worth of coverage. That same 10-unit structure that's a co-op can buy a maximum $500,000. And its actual cash value valuation as opposed to condo association is replacement cost coverage. So as Donnie mentioned, if you need $2.5 million, you buy $500,000. Its actual cash value, you have to go to what is called the excess flood market, which is surplus lines. Not really admitted markets out there doing this. It's surplus lines carriers. And of course, they've experienced Ian, Helene, and Milton. So they've experienced some challenges, no doubt. Can one probably make a better argument that flood panels or barriers of some sort installed, not yet tested, I guess, per se, right? Built. That they've really been tested here in Southwest Florida, I think.
Yeah, we used some on Gulf Shore for, Helene?
Is that right? Okay.
And some worked, some didn't. Newpers, if you're looking at doing flood walls, let's have it go.
Yeah, so it's relatively new. I think there's going to have to be some experience in that marketplace to see the fact that they actually work. And again, we're really talking about co-op. Co-ops have the biggest challenge, I think, because they can only buy $500,000 per building. As opposed to a condo association. So the need for excess flood is higher, you know what I mean, when it comes to a co-op than it does to a residential condo association because of the limits that you can purchase. I think it's going to take time. I think Ian, Helene, and Milton are so fresh in the carrier minds that in that marketplace too, we've had carriers that have just exited the market completely. And those that are left, it's kind of like the umbrella market. Fewer participants, the price goes up, the terms deteriorate. That's kind of what we're experiencing right now, but I do think that'll be an argument for the future. Now, you might find that an excess flood carrier, FEMA doesn't have this because they're not giving you any credits, but an excess flood carrier might put a warranty in the policy that says that's got to be installed. Meaning if it's not installed, the flood happens. If you want credits for something, it's got to be there.
It's kind of like hurricane shutters, right? It's so hard to prove the shutters were up.
Yeah.
And so I haven't seen on a wind policy them requiring to prove that
No,
they're up.
no.
They just say you have to have them, and hopefully you're intelligent enough to put them up.
You might find in the surplus lines market where some of them put, protective safeguards, warranties in the contract, again, something to look out for. But again, you typically don't see that in a standard line admitted carrier product. When it comes to excess flood, can you make an argument? I would say this. You don't put the barriers in the hope that you'll get some premium relief. You put the barriers in to thwart the floodwaters coming in. And if you get some premium relief that your agent can argue or advocate on your behalf in the marketplace, then fantastic. But I would say right now it's not something to kind of count on, because again, we're still kind of reeling from Ian, Helene, and Milton. And there just aren't that many participants, and there's still high demand, on the part of co-op. That's a really tough co-ops. I've got a handful myself. We've got some mutual co-ops we work with, and some buy excess flood insurance and some don't. So, it can be cost prohibitive.
Yeah, I think that the unfortunate reality of the cooperative is that they will end up going extinct sooner or later, because this is just my personal experience, most of our co-ops are right on the beach.
Yeah.
They are late 60s, maybe early 70s. They are struggling with the FEMA rules for rebuilding after storms, when the storms occur. They're struggling with valuations because generally cooperatives will have, if you had a condo and a cooperative that were identical sitting next to each other, the condominium is going to have a higher value because of the cooperative structure and that perpetual lease agreement. It's hard to get, as far as loans and all of that go. So I have a feeling that many times, when there are catastrophic events, it is sooner or later just going to force, and the cost of operations is substantially more expensive because of flood insurance and a number of other things.
Yeah, I think we've seen that already, a couple examples where they've terminated.
We have a dissolved. I think now we've got 7, not year to date, but 7 since Irma that have dissolved. So that's what, 3 years, 4 years?
I can't recall, but I think it's less than 100 that there actually are co-ops. Because, like you said, it was somewhat popular in the 60s or 70s. You know what I mean?
Yeah. Well, I wouldn't be surprised about that, because Newell manages at this time probably 15 co-ops, 10 or 15 total across the whole spectrum.
Yeah, and FEMA, for whatever reason, that's their rule, and they haven't changed that. I don't think they have any plans on changing. And I've had co-ops that investigated conversion to a condo. And there's a lot of struggles there, but also then if you do something like that, you're no longer eligible for the legacy rating of flood insurance. I mean, you start with the new equity in action, so you go to...
And you're also in... There's a number of things that impact it, because for the most part, it would be an expensive proposition, which would likely not pay off with any of the savings, because they have a capital gains event that occurs as well.
True, yeah.
Each one of those owners, they all have capital gains events. If you've got anybody has a co-op that wants to convert, we've got folks we could talk to. We haven't made it happen yet. All right. Well, Doug, I really appreciate all your time.
Thank you.
We promise next time you probably aren't going to get a heads up on the questions, but they won't be stuff that's only been in effect for 2 weeks.
I guess. Okay. Yeah. Okay.
It'll be stuff we know of.
No, thanks for having me. I appreciate it. And if any of y'all have any questions, feel free to get in touch with me anytime. You or your boards too. I'm a big believer in meeting with the manager, but also the board too, to educate. I don't expect you to communicate what I tell you, per se, to the board. Invariably, there are questions they ask you, and then you ask me, and we go back and forth. And I'm a big believer in all of us sitting down around the table or Zoom or whatever the case might be, and kind of hashing everything out right there.
Thank you very much. And Newpers, have a great week.
Thank you.